New York City wakes to chaos. Men in suits crowd outside the New York Stock Exchange. Papers fly, phones ring, faces turn pale. Fortunes disappear in minutes. Bankers whisper the same terrifying word: collapse. Within weeks, the American economy will begin a downward spiral so massive that it will reshape the world. Millions will lose jobs. Thousands of banks will fail. Global trade will collapse. And historians will ask a disturbing question. What if this disaster started with just one man? A man who believed he had mastered the market. A man who borrowed hundreds of millions of dollars. A man whose downfall may have lit the spark that burned the global economy. His name was Jesse Livermore. And this is the story of how one trader's gamble helped trigger the greatest economic disaster in modern history. To understand this story, we need to go back to the roaring 1920s. America was booming. Factories were producing more than ever. Cars rolled off assembly lines. Radios filled living rooms. The stock market became the new gold rush. Ordinary people were suddenly investors, teachers, farmers, taxi drivers. Everyone wanted a piece of Wall Street. But there was one dangerous twist. Most people weren't buying stocks with their own money. They were borrowing it. This was called buying on margin. Imagine buying a $100 stock with only $10. The broker lends you the rest. If the stock rises, you profit big. But if it falls, you owe the money. And by 1929, 90% of stock purchases were happening this way. The market had become a giant tower built on borrowed money. All it needed was one powerful push. To understand the crash, imagine the stock market as a massive game of dominoes. Each domino is an investor. Some are small, some are huge, but they're all standing close together. Now imagine someone removes support from the largest domino in the room. Suddenly, everything begins to fall. That large domino was Jesse Livermore. Livermore wasn't just another trader. He was a legend. By the 1920s, he was already famous for predicting market trends. Some called him the Boy Plunger. Others called him the Great Bear of Wall Street. He had an uncanny ability to sense when markets were about to fall. And in 1929, he saw danger everywhere. Factories were overproducing. Consumer debt was exploding. Stock prices were absurdly high. Livermore believed the entire market was a bubble, so he made a bold decision. He began short selling. Short selling is essentially betting that prices will fall. You borrow shares, sell them immediately, then buy them back at a lower price. If the price drops, you profit from the collapse. Livermore didn't place small bets. He bet hundreds of millions of dollars against the market. In today's money, that would be billions. At first, nobody noticed. The market kept rising. New investors poured in. Wall Street celebrated record highs. But beneath the surface, Livermore was quietly building the largest bearish position in financial history. Then came October 1929. The market began to wobble. At first, it looked like a normal correction, a small drop, nothing unusual. But Livermore didn't flinch. He increased his bets. And then, the selling began. Huge blocks of shares started flooding the market. Prices slipped, then dropped, then plunged. Panic spread through Wall Street like wildfire. Investors who bought stocks on margin received terrifying phone calls. Margin calls. Your stock has fallen. Add more money or we sell everything. Most investors couldn't pay, so brokers dumped their shares, which pushed prices down further, which triggered more margin calls, which caused more selling. The dominoes began falling. October 24th, Black Thursday. 13 million shares traded in panic. The market collapsed again days later, Black Monday. And then came the worst day, Black Tuesday. 16 million shares sold in a single day. The Dow Jones lost nearly 25% of its value in just 2 days. Inside Wall Street, chaos ruled. Men shouted orders, traders fainted, fortunes vanished in seconds. Meanwhile, one man was watching quietly, Jesse Livermore. And as the market collapsed, his short positions exploded in value. He made an estimated $100 million. Today, that would be over $1.5 billion. But something far bigger had begun, because the crash didn't stop at Wall Street. It was just the beginning. Once the market collapsed, confidence evaporated. Banks had lent money to investors. When stocks crashed, those loans couldn't be repaid. Banks began failing. In 1930 alone, over 1,300 banks collapsed. People panicked. They rushed to withdraw their savings. But banks didn't actually hold most of that money, so withdrawals triggered more failures. Businesses couldn't get loans. Factories slowed production. Workers were laid off. Unemployment surged. By 1933, nearly 25% of Americans had no job. Families lost homes. Farmers lost land. Bread lines stretched through city streets. But the disaster didn't stop in America. Global trade collapsed. Countries raised tariffs to protect their economies. International business froze. The crisis spread across Europe. Germany's fragile economy shattered. Political extremism surged, and within a decade, the world would plunge into World War II. A stock market crash had become a global catastrophe. Now here's the haunting part. Did Jesse Livermore cause it? Most historians say no single person caused the Great Depression. The crash was fueled by reckless speculation, weak banking regulations, massive debt, economic inequality, and global instability. But Livermore's enormous bets accelerated the panic. When powerful traders start selling, others follow. Fear multiplies, confidence vanishes, and markets collapse faster than anyone expects. Livermore didn't create the dominoes, but he may have been the one who pushed the first few over. Ironically, despite making one of the largest fortunes in history during the crash, Livermore's life ended in tragedy. He lost money repeatedly in later years, battled depression, and in 1940, he took his own life in a New York hotel. The man who conquered Wall Street was ultimately destroyed by it. The Great Depression teaches us something unsettling. Financial systems look strong, but they can be incredibly fragile. A market built on confidence can collapse overnight. All it takes is enough fear, enough debt, and sometimes just one powerful move at the wrong moment. Today, markets are faster. Trades happen in milliseconds. Algorithms control billions of dollars. But the psychology of panic hasn't changed at all, which raises an uncomfortable question. If the same conditions appeared again, would we even see the crash coming? So here's the question. Do you think one person can still crash the global economy today, or are modern markets too big for that to happen? Let me know in the comments.